morning. Welcome to the Brew and welcome to the last week of September. I think I'm dreading the winter, but not the fall. So anyway, we'll get to that in a second. We're going to start our series of Options 101. We're going to take it all the way up to advanced options. So we're going to spend a couple weeks starting now with Options 101 and moving through the progressions. So there's a lot to learn. There's a lot to talk about. We're just going to take little snippets each day, about a half hour, and then keep building on it. So stay tuned for that opening bell. Molly, you're on mute. You are muted.
This is great. It's a Monday, right? It's a Monday.
I know.
Good
How
morning.
you doing? How was the weekend? Good?
I'm good. Weekend was excellent. How about yours?
Yeah, it was good. You know, I had a wedding. I still go to weddings, right? But they're
Yeah,
not
did you
weddings of
crash?
people
Were you
my age. Yeah,
Were you invited?
I was invited. Yeah.
Okay. You didn't
At my
crash.
age, you don't get to go to weddings of people that you know, your age. You get to go to weddings of the kids of the people you know.
Right.
So,
Oh,
yeah,
that's
that's
cool.
where I am.
Keep the party going.
And I always
I
get
like
the table, you know how they put wedding tables together, right? All the cool people around the dance floor and the band and all the cool spots.
Yeah.
And then the old people are another row or two behind that. I'm in that
Right.
row. That's where I am.
Right. I went to a wedding recently and they put me with a group that really I understood what they thought of me. I was like with the total surfer. I think I was the only one who had a job. So I was sitting there, I'm like, okay. But we had the best time though. So they probably made a
Good.
good decision there.
Yeah, no, it was fun. It was good. And I just I watched the Chicago Bears make fools of themselves yesterday. So I got that going for me.
Aw.
Yeah. Anyhow.
Well, so let's touch on the news a little bit. We've got a couple things cooking.
All right. Fire away.
First, we should just mention, the floods and the earthquake in Libya. So 20,000 people are. So let's just take a moment and just hope they're all okay and they're getting back on their feet.
Mhm.
But we also have we see so September's coming to a close and we have 23% of the S&P 500 has reported earnings and quarterly earnings, and of that 76% beat expectations. So it was a good September. Normally
Mhm.
September's a slow September. People are on vacation. On August someone went to France, so that's reflected in the market.
Right. That would be me.
Well, we had a great September. And then we have UAW is still going strong there, and there's some pressure on the EV market, so we might want to take a look at the growth of Tesla,
Mhm.
because they're not attached to that. So that might be an interesting look. And then China's still buying gold. So China's buying gold, and they're dipping into their dollars and their bonds. So they're unloading that on the market to buy that gold, which then drives up the yields on bonds. So those will be affected. And also might want to see the currency. So our dollar against other currencies, see how that, now that there's more supply.
Well,
And
someone did some homework over the weekend. Hello.
yeah, I know. We're doing news in the morning. We're gonna step back on that, so we get that
Nice.
covered
Okay.
right before we get the gold from you on strategies. That's the real
I love
juice.
it. That's perfect.
Yeah.
So what you said something. Oh, UAW strike. So
Yeah.
we talked about a little bit about that with Paulina on Friday.
Yeah.
Oh, I dropped my pen. That's really bad news bears. Hold on. Got to bend over to get the pen. So I did read something this morning actually about the screenwriters strike that looks like maybe that's coming to an agreement of sorts, right?
That's in my neck of the woods, and there was talk that they wanted to wait as long as they needed to shut SAG down. And so
Mhm.
actors came out of the woodwork, and they are deciding to only do movies that SAG approves. And so that was their counter strike. and it seems to be working. And so a couple of movies have been released. Commercials are now released. So those are back in the swing of things. And I think negotiations are probably on their way. And we should see, the expectation is first of the year. So we still have a couple months there, but first of the year that should level
am I
out.
still watching reruns? Is that the idea?
Yes. Yeah.
Okay.
Right.
You know.
Just, actually I found this trick. I talk to my Apple TV and I say, show me movies from the 80s or 90s. And I'm telling you, I'm enjoying them much more. The CGI just kind of gets me at just too much. Yeah.
Love it. Well, that's good news, I think. So with all this, right, we're going to start, I'm an options person, right? So I know things about options. And so everyone asks me, hey, what do you think about, XYZ stock? Do you think Tesla's going up? And my common answer is I have no idea if Tesla's going up, right? I'm not a fundamental analyst, but if you can tell me what you think about Tesla, up, down, or sideways, we can create an option strategy around it to take greatest advantage.
Yeah. I mean, I'm assuming it's going to go up with the strike happening.
That's good. And you know what? We don't want to just be cavalier. And I keep looking up. I tell everyone I'm looking up only because I've got this tanning booth and I'm trying to get better sun. No, I'm kidding. That's my upper screen that I'm looking at where the Trade Hawk is. And I'm looking at Tesla, as a matter of fact.
So, and then Apple came out with, I think, their new devices, so that they should have an uptick too there.
Yep. Everything's mildly unchanged, except for I think the market was down a little bit on the opening. I haven't looked yet where it is. It's still down a little bit, it looks like.
And they say that it's down because we're still looking at inflation, and inflation is hitting that 5% plus mark.
Yep.
Not anywhere near the 2% they need, and so they're and with the strikes, and that's, people are a little worried there. And but I think we have a CPI report coming out soon, so we'll keep an eye on that.
Makes sense. Okay, so anyway, we'll go through some strategies. I'll keep my eyes on the bevy of stocks I like to look at. I like to look at the big names, the ones people know, the ones that are more liquid, right? That you can get in and out of well. And the typical suspects. Apple's a good one. You mentioned that. I look at Amazon. I still have Baba on my screen. I don't know why. I think I've lost so much money in Baba that it's like a labor of love now. So it's my baby.
Right.
What else? GME still on here. I'm looking at my watch list, by the way. Microsoft, Netflix, NVIDIA. I always have the QQQs up there for, just a technology play. Spiders and Tesla. So that's my little watch list of now. Anything can jump in, anything can jump off. For me, it's all about, implied volatilities and opportunities and all that kind of good stuff, which we'll get into as we run through the option series, right? And we're going to start at the beginning today. Is that right?
I think that ARM IPO is really interesting. So can we put it on your list since you're the expert and keep an eye on it?
Is it ARM, like my arm?
I think so. And then I know you gave some really great advice to the retailers to wait till it levels out, and Paulina also gave that same advice. So don't jump in just yet.
Yeah. So,
but if you think it's overvalued,
let's do a little research overnight on ARM and get all the details of where the IPO price was and all that kind of stuff. I see some values up here, and I just don't know off the top of my head where that baby was pegged when it opened. And we can look at some implied volatility. It's not going to be much of a study because it hasn't traded, right? So people right now are trying to make markets, and I'm looking at the money options with 4 days to go being about 20 cents wide on $1.50 option. That's pretty wide. So I don't know if it's doing much volume, but we'll look into that maybe tomorrow or the next day. Okay, let's get busy. We only have about 15 minutes, right?
All right.
So
time flies with you, Lex.
Time flies. Options 101. So again, people aren't watching this live. They can always get this on the Brew or the Tradier Hub. It's going to be a series. I think it's going to be separate episodes, I'm guessing. I don't know how we'll display it, but we'll figure that out. But we're going to start from the basics, and I'm going to go through the path that I learned from my mentor, mostly. And then we developed some of these other things, ourselves along the way with our trading firm way back when. So this is the newer version of it, but you got to start somewhere, right? You got to start with what is an option. So let's go to the screen and see if I can figure out how to do this. Okay, isn't that
All
pretty?
right. Yeah,
I
that's great.
I love blue. It's a good color. I don't know. There's nothing. This is nothing. So we're gonna start with what is an option, right? So let's just get right into the basics, right? Um, so back in, I want to say it was around 1973, right? They had this options existed, but listed options in this country didn't. So it's an option is simply a contract giving the buyer the right, but not the obligation to buy in the case of a call or sell in the case of a put the underlying asset at a specific price on or before a specific expiring date. Okay?
Okay.
Makes sense? Any questions on that? Is that clear enough, you think?
Yes. People
So
toss around the word future. Does that
yeah,
fit in
so
here anywhere?
it's a derivative, an option contract. They call it a derivative. The reason it's a derivative is because these options, their prices are based on something else. And in this case, it's the underlying asset. Okay, that's point number 3 here down at the bottom. Its underlying asset helps derive the price of this option. Okay, so when you have options, you can ultimately purchase the underlying asset through an exercise process. And we'll get into that in a second. Okay, what's the maximum risk of owning an option? Well, you're not getting options for free, right? It costs you something. That cost is what you pay in what's called a premium. Okay. So there's a premium for every option. And, premium is sort of synonymous with the price to own that option. And think of insurance premiums. When you buy insurance, you have to pay a monthly premium for that insurance, right? It's kind of like an option. An option is a good insurance policy for most. You don't have to put up a big sum of money to own the underlying stock. You can put up a smaller sum of money to own the right to own that stock via this option thing. Does that make sense so far?
That is just, I mean, I love options. Isn't that a really great way to get into the market if you can't afford an expensive stock?
Yeah,
Just really
that's
neat.
good. It is for sure. However, as you're going to see with this stuff, there's a lot to learn, right? You can live in the basic level, I think, for a while, but at some point you're going to say, I need to do something a little cooler, and it's going to require you to understand the risks. And I highly recommend to everyone. OCC, the Options Clearing Corp, has a great risk disclosure document that you can get online. You should read it about the risks of buying and selling options. It's important to know. We're going to talk about that along the way. So I always like to put that little caveat out there that, if you don't know what you're doing, it's not as easy. It can be risky, but I would pose to everyone that if you understand options, they are as not nearly so risky as people make it out to be. And again, there's an education part there, right? So the maximum risk of owning these options is what you pay for them. Okay, that's owning them. Conversely, if you sell these options, your maximum risk is potentially unlimited, right? On the sell side, right? Just like selling stock, unlimited upside exposure, right? Options are the same way on the short side, meaning selling these options, assuming that you don't have another long option against that. So the naked sale of, I would call it naked selling of options, has great risk to it. Okay.
Right.
And I'll tell a story about how stupid I was once being naked short options. That was a big deal back in the trading days. All right, let's go to
And just
slide number. Go ahead. Sorry.
on that note, I've noticed, if you tell someone you trade options, their response is they only know the naked side. So they only know the risky side, but there's also a very safe side. And I believe that regulation allows people to trade inside their 401k using certain option strategies because it acts like insurance. So it
Yep.
becomes the most safe. So it's either the riskiest or the most safe.
Yep.
Depends
So
on
yeah,
what
so
side you're on.
we'll get into some specifics relative to that and show how that excuse me, how that works. But excuse me. um, what I would tell you in the retail world, okay, very different from the professional world, is that there are requirements in terms of money, margin money, and the amount of money you have to post to be short these strategies, long these strategies, etc. Right? So they're going to sort of act as a protector of sorts. They're not going to let you do naked options unless you have a ton of money. And then when you have a ton of money, they're going to make sure that when you sell a naked option, that it's not going to blow out your account because you're not going to be able to do enough to to blow out the account. So, it's those kind of things I think in the retail world are pretty good. They kind of protect yourself from yourself in a way. But
it's less of a free climb and you're belaying down with a rope.
yeah, exactly. And I would also say that, if you're going to get into those strategies, you really have to know what you're doing. So we're always going to preach risk-defined strategies on this show. Okay, I'm a big fan of that. Even if I went back to the professional side, I'd still be more of a risk-defined, and we'll see what that means in a future episode. But let's keep rolling here. All right, so we got what an option is. Okay, now some key points, right? Buyers control the exercise of an option. You can take this option in American style options, okay? And the American style option is one that can be exercised before the expiration date. A European style option is an option that cannot be exercised before the expiration. Only on expiration date can that be exercised.
Europeans are more civilized.
Seems like it, right?
Okay.
Seems like it. Then that's one of the things I hate about options is the American style of the early exercise. Because if you're short an option, you can get assigned. Okay. And I think that's going to be the next slide, but let's stay here for a second. So buyers control the exercise, sellers can be assigned, and sellers don't necessarily know when that's going to happen. Okay. If it's an American side, you can get assigned during the course of the term, or you can get assigned at expiration when that stock closes, in the money for a put or in the money for a call. You can get delivery of the underlying asset. So you got to be careful there. Okay. This predetermined price that we talked about, right? Options give you the right to own or sell stock or the underlying asset at a predetermined price. That price is called the strike price. Okay. Or strike. We call it strikes, that kind of thing. So the exchange lists these strikes in increments. And, I think it's changed so much over the years. They've got dollar strikes, they've got $half strikes, they've got $5 strikes. Typically what happens is that when there's near dated options, you tend to see more strikes in dollar increments. Okay. Near dated meaning they've got very little time before their expiration. So 0 DTEs, 4 days to go, 1 week to go, 2 weeks to go, etc. You'll tend to see more strikes one right after the other, and those short dated options. And then the exchanges list more like $5 strikes in farther dated options. And there might be a rule. We're going to look that up. Like at 45 days, it might be you don't get any weeklies, 45 days and beyond. It's just the monthly stuff. So there is some sort of consistency to that. Okay. That predetermined time we talked about when options expire, obviously it's expiry or expiration. I think expiry is a little bit more of a European word because they drink wine with their pinkies out like that. And expiration is more of the American version of it. But I use both of them. I like to say expiry or expiration.
Expiration is more cowboy.
Okay. Yeah, more cowboy. I got a cowboy. I got it's my Yellowstone outfit.
Yeah, you're looking good today, Lex.
Oh, thanks.
Stylish. I like your swag.
My swag. So this is how the nomenclature of an option looks. It'd be the date, December 21st. The 21st is the expiration of that option. Okay. The year 2023. The next part of that is the strike price. In this case, it's the 350. And then you always add whether it's a call or a put. Okay. So far, so good.
It's great. This is amazing.
And that's very typical how this looks. Now, in code language, you get a bunch of numbers. So December would be represented as 12, right? So code language, it looks very confusing. It's a string of numbers. It's annoying and you can't find anything in it. So we always pull out and make it look like, what a human being can read. And that's how we do it in TradeHawk as well. So it kind of looks like this, but this is very typical. December 21st, 2023, 350 call. Now we would say the DECE 350 call, right?
Oh, okay.
We would just go there. DECE. We'd say the first three letters: DECE, SEP, OC, OG.
And what are some floor signals? What are some? Give us some
floor
signal on that.
Well, with 350, gosh, 350. I can't even remember. 300, 350, like that. Okay. And call was this.
Okay.
Right? C. And put was this.
Put, right?
Yeah.
Okay.
Yeah. Put looks like a P. Call. So then that's how you communicate it across the pit. I didn't have to do that because we were in a fairly small pit of about 20 people back in the day, compared to a pit like the OEX and the SPX which had hundreds of people in it. So you
Okay.
needed your hand signals there. But in our little boutique, we were like a little Chanel store, right? We had a
But you
little
had
Chanel
Google.
or a
You
little
had
Gucci
some of
store over there. It was real small. No one was in
great.
it. But when you came there, it was really fun. We served
Yeah, I
water.
imagine in your pit, I imagine, wine glasses hanging, you know. I'm imagining that.
The feng shui was very perfect. I swear. We had a good color scheme too in our pits.
Oh, that's brilliant.
Um, and incidentally, in the pit days, which we don't have anymore, every trading firm had jackets, and you can see my jacket behind me, sort of. It's way
Oh,
back
there we
there. But
go.
we all had firm jackets, and they were all the same color. So your firm had a specific color, and again,
Okay.
we picked the colors. I like black and purple, so there you have it. And it
Very
had your
cool.
little patch on it of your acronym. My acronym, surprisingly, was what? Lex. That's what I go by. LEX. You had to have a 3-letter acronym. After a certain period, you could have 2 letters in the early days, but then afterwards they made them 3 letters.
All right.
So I chose Lex, right? So everyone had an acronym, and that's how you carded the trade with another person. So if Molly, yours
Okay.
was MOL, let's say, pretend I type
All
in
right.
MOL, your clearing firm, which is a number 671, whatever it was, 256, and you type in LEX and then 671 for me, and then you
Okay.
submit that at the end of the day, or in the electronic days, you just hit buttons, and it would go to clearing right from there.
Was that like Lucky Earnings Exchange? Was that an acronym?
No, it was like Lex Luthor.
Leveraged Earnings Exchange?
It was Lex Luthor, the greatest criminal mind of all time, about Superman, right?
Right.
All right, so we got this basic setup of what these options are. We've got calls and puts, okay? So what we have now are 2 types of options. We've got a call and we got a put. And it's funny because when you look at an options chain or a grid, the calls are historically on the left as you're looking at it, okay? And I have a trade hawk up, but I'm not sharing it, so I won't do it. And puts are on the right. So I get, some of the beginner retail folks, and they're like, where does it say call? I'm saying, well, here's the deal. It says if you scroll up, it says call. But just so you know, everyone who trades these things, calls are always on the left and puts are always on the right. Then they get
Right.
clever and they move the strike column all the way to the left, so the calls and puts are next to each other. I'm like, okay, do what you want, but just so you know, this is how the old timers look at it.
To each their own. When in
To each
Rome.
their own. All right. So some characteristics of the call option. Okay, they're different, right? Calls typically increase in value when the underlying asset moves higher. Okay. Additionally, calls have positive deltas. We're going to start doing deltas probably tomorrow. Okay, we're going to take each delta each day. Each Greek each day. So calls behave like the underlying asset. Now, there's very much key differences, right? It's a derivative contract, etc. But just think, calls can get more valuable as the stock goes up, and they get less valuable as the stock goes down. Okay, so they mirror the price of the stock, or they can mirror the price of the stock. Okay. If you exercise a long call, you own the call and you decide to exercise it, okay, you will get the underlying asset. Conversely, if you are assigned on a short call, you will be short the underlying asset, okay? And keep in mind, options are tricky this way. One option controls 100 shares of the underlying asset, not 1 share, but 100. So everything's in 100 increments. So if you pay $5 for an option, a call option, right? That $5 is not really 5 because we got to multiply by 100. You're going to have to put out $500 to get that. Does that make sense?
Yeah, absolutely.
So, think about it. You could do an at the money option that says $5. Okay, and at the money, well, again, we're going to get into this. It's a $50. You need 2 of these things. So it's going to cost you $1,000. $5 times 100 is 500. You have 2 options, it becomes 1,000, right? And let's say your stock was $70. So to own that 100 shares of a $70 stock, right, you got to put out $7,000 for 100 shares, right? So little different dynamics of how leverage you can make your money by using options. Now, as you're probably thinking, well, what's the catch? Well, there's always a catch, right? There's a huge trade-off with options. And that's what all the Greeks say. So owning options, they waste away. There's theta and time decay. We'll get into that later. But there's always it's not hidden, it's very obvious sort of trade-off to this stuff, okay?
Yeah, just to break this down for someone who's never traded before. So calls would be, you know, those two first line items there is, especially that first one. If I'm going to sell you this phone for $20
Mhm.
and, the going rate for this phone is now 100, it's gone up. Well, that's a good deal. So that becomes that $20 offer, that call becomes valuable. So that's you can trade that higher because you're
Right.
getting that phone at a discount. Now, if that phone is now $5, you're not going to pay above market value. So it's gonna get tossed
Yeah, and that's the
in the
beauty. That's a
wind.
good example, Mal, about the use of options is that, they're a future dated sort of entity, right? So back to your phone example, you could say the phone is, I forget your numbers were, but let's just say it's $100. And you could buy a $50 call on the value of that thing in the future. And as you said, if the and that's going to cost you something. It's going to cost you some premium, right? And if that phone goes up in value, you're going to make the difference between your strike and where that value is less what you paid for it, right? If
Exactly.
it goes
Right.
to zero, the phone's worth nothing, you're going to lose what you pay for the call. That's it, right? You don't lose the full value of the phone. So it's beautiful in that you don't necessarily always have to take delivery of any of this stuff. You can close expiring options out. You can buy or sell them to get out of them and then roll them out into another term structure, into another expiration, and always
Right.
avoid, getting assigned on this stuff, right? So there is special characteristics of early exercise. We're going to talk about that in the 505 class. We're in the
That'll be
101
a good
class right
one.
now.
Yeah, that'll be a good one.
That's a little tricky. We're getting Matt Cashman on. He loves talking about that. Okay, let's do a put option real quick. I see the time. We got to get hustling. Okay. Oh, let me go back one. Sorry. Calls. So this is the graph of a typical calls up here in the top right, on my top right. So typical graph of a call, it looks like a hockey stick, right? So to the downside where my cursor is, you can lose what you pay for it. So the difference between this zero line and this price here is what we paid for that option. Okay. And it doesn't show a premium, but let's just call it $2. Okay. So that's what you can pay. To the upside, you start making money once you get beyond $2 in our example, what I just said, plus the strike price. So if this strike price were 50, I'm just making it up, and you paid 2, at 52 is where you start breaking even. And then above that, you start making money. Okay. So that's what this graph represents. This premium you paid for it. And then you can see to the upside, this premium until it gets to break even. Right. And then beyond that, it's all pure profit. So it's like that little hockey stick for a long call. All right.
I love that.
Puts. Well, puts are the opposite. So puts typically decrease in value when the underlying asset moves higher, and they increase in value when the underlying asset moves lower. So puts are good for downside moves, being long puts. Okay. Puts also have negative deltas, right? So you got to think in reverse, calls and puts. Okay. So the exercise of a long put results in a short position in the underlying asset. Okay. If you're short a put and you get assigned on a put, and those two terms, exercise and assignment, okay, are important to know the difference. Exercise is something you do as a holder of the option. Assignment is something you get as a person who is short the option. Okay, so you don't have any control over the assignment part. You do have control over the exercise part. Make sense?
Absolutely.
So with a
Assignment,
put,
you're on the hook. You're on
yeah,
the
with a
hook with
put, when
assignment.
you get assigned, you're not going to get short stock because you're short that put. You're going to get long stock in this example. Okay. And again, the common thing to remember is that one put controls 100 shares of the underlying asset, and it's a sale in this case when you're long it. Okay. Any questions there, Mal? Because I'm cooking. It's
I know you're
9:30.
cruising.
It's time for eggs and bacon or something. All right.
So put
Last
options.
slide.
Okay.
So the marketplace allows you to put combinations of calls and puts together to make what we call a spread, okay, or a complex order, all kinds of things you can think about it. So there's numerous types of spreads. I'm sure people have heard of butterflies, put credit spreads, call credit spreads, debit spreads, iron condors, you name it. There's tons of them. And there's even some weird ones like Christmas trees and broken wing butterflies. So we'll get into all of them ultimately, but know that you can put together combinations of options, longs and shorts, into a spread, right? And send that whole package to the marketplace as a package, and you can trade it as a package. to me, this is the single most powerful aspect of options. Okay. You have the ability to take advantage of a move in a direction or not a move in any direction with these spreads. And spreads can have, all kinds of Greek components to them. You can take advantage of theta decay. You can take advantage of big moves. You can take advantage of little moves. You can be directional. All kinds of things can happen with these spreads in the combination and package of these spreads. And we'll talk about each one of those, as we get through the whole series here. Currently, to the best of my knowledge, the exchanges allow individuals to send up to 4 legs in a spread. What that means is 4 individual options can comprise a spread. Now, I've heard people say, that you can send 6, but I haven't seen that anywhere yet. So I will.
And what's,
Yep.
The more complicated you get, the more the more legs you have. Is there a significant increase of, margins you make or income you can pull in? I mean, is it worth it to get? Because the more complicated, the more error, room for error in your experience.
Yeah, it depends. Look at I have a little note here that these legs can be ratioed to one another, so they don't have to be 1 to 1 to 1 to 1. In the case of a 4-legged spread, they can be 1 by 2 shorts by 2 other shorts by 1. They can be all kinds of ratios as well. So yeah, when you have short units, what I mean by short units is the sum of the shorts in the spread versus the sum of the longs is a negative number, meaning you have more shorts. That's when there's risk because you're naked short something. And I'm not a big advocate of that. I'm a big advocate of risk-defined strategies, which means in spreads, the ratios of the long legs to the short legs is 0.
Right.
Okay. Or you could technically say it could be long 1 or 2 or 3 or whatever, some ratio. So I like that too, because now all of a sudden you have the ability to make a lot of money on big moves if you're long extra units. Okay. And again, we'll look at all these kind of spreads in future episodes.
I think education is the tip of the sword, and you can really be open to, climbs, and, you can pull in a lot of income and still cover yourself with it, and anything with a little bit of complication. So you're talking about 6 legs.
Yeah.
Sorry, that's my dog.
Yeah. The exchanges only let us send 4 right now. So we can only send up to 4. I've heard, there's grumblings about 6, there's grumblings about 8. Look at what's the case for sending 8-legged spread. Here's what it is. Here's the best case, at least in my mind. Someone has an iron condor on, which happens to be 4 legs. Okay. It's a combination of a put spread and a call spread. So there's 4 legs. So the best case for 8-legged strategy is like, hey, I want to close out my condor I have on. So I want to close out the 4 I have on and roll it out to another expiration all in one piece. So now I've closed out the front. Those are all closing. And then my new strategy, which might have new strikes in different places because the stock moved. That's a good case for an 8-legged spread, I think.
I see.
Right? Does that make sense?
And I would say if you're just starting out, keep it simple. Don't, you can be really risky if you play around.
Yep. There's some basic 2-legged spreads and even, some 4-legged ones, but there's some basic 2-legged spreads that are very easy to understand. We'll go over them to use for, some sort of directional or non-directional sort of play. So we'll talk about those in a future episode. Okay. Last thing, we have to go. So I said 4-legged. So the other thing to note about spreads, when you create a spread and submit it to the marketplace, it's traded at the spread price, whatever price you put in there. Okay. Now, obviously, you can put things as markets and all that. I don't typically recommend that. But what I mean by a single price is that the sum of the long legs and the short legs, whatever that adds up to be, it's either going to be a credit or a debit. You're either going to get something because the sales are going to be at bigger prices than the buys, or you're going to pay something, in which case the buys are going to be bigger than the sales. So one's called a debit spread. That's when you're paying for something. Okay. The other one's called a credit spread. That's when you're getting something for the spread. Okay. So you've sold more bigger prices than what you're buying.
And that's a great one. So rewinds, listen to that one again, because that is used a lot. It's really important to know.
It's really important to know that. Now I tell you, our system, TradeHawk, when you combine these things together, it automatically tells you whether it's a debit or a credit. You don't have to understand, or you don't have to do any math. It does it for you. You just have to know, hey, am I supposed to be doing a credit spread or am I supposed to be doing a debit spread? And if so, it better say debit or credit on that ticket before you send it out, right? Otherwise, you're doing something wrong. So you don't have to figure that out. You just have to know what you're doing when you comprise these things, right? Or compose these things. Okay. Good deal.
Great. Thanks for that. Love these
All right, so
slides.
that's real 101, I'd say. We know what a call is, we know what a put is, very basic, right? We know what an option is, we know there's strike price, there's expiration. We know we can combine these things into complex orders or spreads, right? Oh, I spelled spread speeds. Unbelievable. I just looked at that. I go, what is a speed?
It's really
Look at this.
fast.
Oh, hold on. We have a speed. See it up here? So it's our new term. We have
Yeah,
speeds and we have complex orders.
I love it.
Unbelievable. So anyway, so we've learned that part. Now we're going to get into, starting tomorrow, we'll get into some of the Greeks of these things and talk. We'll start with Delta and go right down the line.
And if one day we could ask you, so when you buy a stereo or you buy anything, it comes with instructions and you set it up. So it's one thing to know this, but it's another thing to hold someone's hand and actually show someone how to open a brokerage. Then what's your next move to actually
Yep.
buy, to get in the game?
Perfect.
In a real way. Yeah.
Yep, it is. All right, Ma. Well, guess what? That's a lot
Thanks,
for a
Lex.
Monday.
All right.
Are you good?
I'm great.
All
I'm
right.
excited for tomorrow.
We'll keep chugging along tomorrow. Have a good day, everybody. And that's the close for today.
All right. Bye.